It is no secret that the electric vehicle industry has immense potential for growth in the next 10 to 15 years in markets around the world. Some of that growth has already materialized, especially in relatively mature smaller markets such as Norway and in large markets such as China. Governments around the world are providing incentives and setting targets for faster adoption of EVs. What implications does this have for investing in companies competing in this industry, whether it be electric vehicle manufacturers or battery manufacturers or EV charging companies? At the moment, this industry is highly competitive with many players and new entrants, although there are larger players in the industry with a more established track record, for example Tesla and BYD. In the US, many traditional auto companies such as GM and Ford have, in the past few years, dramatically increased their investments in electric cars. Several auto companies have also announced that they will build a network of tens of thousands of chargers to compete with Tesla's supercharger network. Chinese electric vehicle makers led by BYD account for a significant part of the electric vehicle market in China and are expanding to overseas markets, including those in developed countries. Both Tesla and BYD shares have delivered impressive returns in the past 10 years. They were early movers who executed well on their strategy. With the industry in a far more competitive state right now, it is much harder to predict which companies will emerge as winners and consolidate their position in the industry. Established auto manufacturers such as GM and Ford may have deep pockets, but newer players such as NIO, Lucid and Rivian may be more nimble and agile and have the advantage of being more focused in this space. Also, many of these newer companies often have investors with deep pockets, so they have the resources to execute on ambitious strategies. 10 years from now, the industry will become more mature and some degree of consolidation is to be expected. Given the head start for companies such as Tesla and BYD and the pricing and technological competitiveness in case of BYD and access to charging network and focus on driverless cars in case of Tesla, these early birds may still be the winners at the end of this decade, with further returns in store for long-term investors. But the rise of new players is also likely, both globally and in markets that are currently underserved but which have huge potential, such as India. In India, EVs are, as of now, mostly scooters and motorcycles rather than cars. Other than EV makers, companies producing parts, especially batteries, and companies building charging infrastructure/EV chargers also have the potential of providing investors with good returns over the next 10 years. Given that this space is even more fragmented than electric car manufacturers, it is probably even harder to predict tomorrow's winners. This is further complicated by the fact that the level of innovation currently happening in the battery and charging space is mind-boggling, so a company leading the space today can be overtaken by a more innovative competitor. Also, there is the risk that the EV industry itself stalls after growing to a certain point. We have already seen several major automakers stating that EV sales in recent months/quarters have not met up to desired levels. There is continued uncertainty, despite many major countries setting aggressive targeted dates by which all new internal combustion engine vehicles will be outlawed. Range anxiety is a very real thing. Even though governments around the world have started focusing a lot more on improving the charging network, a lot of work still needs to be done before consumers can charge their EVs as easily as filling up their internal combustion engine vehicles. Also, there is the potential of vehicles such as hydrogen-based cars and hybrids, which emerge as long-term winners. Moreover, a switch to electric vehicles may not be as climate-friendly as many believe, because a significant part of the source of the electricity may still be fossil fuels in many countries. This may dampen public support for a switch to EVs. The price competitiveness of electric cars and availability of raw materials for parts is another risk. In conclusion, investing in this space is recommended for investors with a high-risk appetite who are looking for high-potential returns. If EVs really do dominate the auto industry 10 to 15 years from now globally, there are likely to be a few very big winners and many companies which go out of business. The investor who can identify even one such big winner stands to gain immensely.